Good afternoon or good morning, everybody. Welcome to another Fintech Nexus webinar. We have a fascinating discussion on tap for today. We're going to be talking all about digital onboarding, specifically building trust and building scalable strategies for consumer and business onboarding. We've got an all-star panel of experts here. We basically have two business-to-business experts. We have a consumer-facing, and of course, we have a digital identity expert. Well, everyone's experts in identity, but for coming at it from various different ways. So with that, let's do some introductions here. My name is Peter Renton. I'm chairman and co-founder of Fintech Nexus. It's my pleasure to be your moderator for today's discussion. And with that, let's start off with introductions. Pamela, why don't you go first?
Thank you, Peter. And thank you for hosting. I'm Pamela Novoa-Riley. I am the Senior Vice President for Product for Proof. I have 15 years of experience leading and developing both products and platforms related to the movement of money, both in financial services as well as technology and SaaS. Through that focus, I have spent a lot of my time and resources across the years investing on removing barriers towards access, particularly around onboarding. And that's actually how I ended up in Proof, focusing particularly about removing those barriers and automating it through digital identity.
Okay, Mira?
Excited to be here. I'm Meera Srinivasan. I'm the Chief Risk Officer at Bluewine. I've been in the risk domain for almost 20 years, managing credit risk, fraud risk, operational risk. I'm very excited to be here talking about onboarding and verification. In the roles that I've had over the years, that's been an integral part of what I manage. Have managed small business onboarding. Majority of my years in risk have been in the B2B space, so more on the commercial risk, and excited to be here.
Okay, Philip?
Hi, glad to be here. My name is Philip Tolliver. I'm with Lendio. Lendio is a marketplace and platform for small business loans. We work with about 75 lenders to source borrowers, pull and analyze third-party data, analyze bank transactions, and decision loans. We just eclipsed 15 billion in total funded loans earlier this week. So really excited about that milestone as a company. I lead our SaaS business along with all of our relationships with our marketplace lenders.
Okay, Bill?
Hey, folks. I'm Bill Walsh. I am the Chief Customer Officer at Sunbit. Sunbit is a fintech focused on giving people more options for how and when they pay for everyday expenses through both a buy now, pay later solution, which is offered at the point of sale in now over 23,000 locations and online in key verticals like auto services, dentistry, and optical practices. And then also through what we're calling our next generation credit card, which is used by over 100,000 people in the last year. And so I think, uniquely for us, we're doing both a B2B2C and a B2C product in Sunbit. So I lead the consumer-facing teams, the customer experience, and the B2C products. And I come to Sunbit after a little bit over 10 years in fintech lending at companies like Innova and Lending Club, and had a variety of different roles there in operations, marketing, and risk and fraud. So excited for the discussion today.
Okay, well, let's get right into it. And we're going to start, I want to hear from the lenders here. What's the biggest challenge in onboarding and verification today? What are you experiencing? And maybe we'll reverse the order here and start with Bill.
Sure. I think for Sunbit, you think of the products we talked about, buy now, pay later, and card. A lot of these products in fintech are designed primarily for online acquisition and for e-commerce purchases. And I think Sunbit is a bit unique in that, in addition to that, our products are built to seamlessly fit into the in-person experience If you look at our core verticals and you look at where 85% of commerce happens, it's in person and it's offline. So for us, the big challenge is that the experience has to be, I don't know, extra good to work and to fit seamlessly in person. It needs to be fast. You can imagine you don't want to be the individual holding up a checkout line as you're completing an application for a buy now, pay later. It needs to be something you can complete in a store. So I think that means, 2 years of W-2s and your most recent utility bill are not likely to be things that you have on you when you're at the checkout line. And then it needs to be designed to get to a decision because, you're going to either purchase or not purchase based on what's the outcome of kind of that onboarding process. And so for us, ideally, we're trying to get to a yes. We aim to approve, 90% of people who are applying for Sunbit. And so you've got all these considerations kind of pushing you for real-time decisioning with limited inputs, but it still has to be really robust, right? It's sort of you're still offering a credit product, and so you have to manage your risk and you have to manage your fraud, but you have to do it in a way that can work in that type of an environment and still deliver a good experience. So you got to be it's probably one of the most critical things for us at least to focus on in order to be successful.
And we'll get into some of the details of that in a little bit, but let's move on to Philip. What's your biggest challenge right now?
Well, we're in the small business lending space. Pulled some research in advance of this. A couple things I wanted to mention. 52% of small business owners cite a time-consuming application process as a barrier to securing funding. 52% is a pretty high number. And the level of dissatisfaction between a large bank and an online or alt lender is more than 2x. So people find it frustrating in general, but find it especially frustrating when they're dealing with an application. And these are small businesses in the survey. The application experience for large banks is particularly challenging. So at Lendio, what we are trying to accomplish is driving down friction in that experience, making it move as quickly as possible. And Lendio makes money in addition to SaaS on funded loans. And our operating plan, we're ambitious. So next year, we're trying to increase the MQL to funded loans by 25%, which is a pretty chunky number when you think about how to cut down on those dropouts and make sure that we find the right loan product. And so for us, it's all about solving those issues, cutting down on friction and improving the conversion of borrowers. And I think anyone, whether they're a lender, whether they're a platform, whether they're a bank, should be thinking along those lines. Finding borrowers is not easy. Putting them in the right loan product is not easy. And so creating the type of experience that enables them to complete that application and get funded and fit for the right product is really paramount to the whole industry.
Okay. Mira, what about you?
Yeah, I completely agree with what Bill and Philip mentioned. Very similar stance. And Bill, it's interesting. You mentioned people being in an online, not in an online space, really in a store with the BNPL, and you cannot necessarily go through a document. But interestingly, Bluewine is a small business focused banking as well as lending organization, and we are completely digital. And generically, the customer's expectation is quick, easy, hassle-free, and instant decision, right? And they want to use the product as soon as they apply. So in that journey, it's interesting. It's about balancing customer experience with preventing fraud, making sure we do what's right on the compliance side, protect the business. And at the same time, I think the trade-offs between making the product available quickly, it's not just about approving and then you send a card in the mail for the next 7 days and then you kind of have controls along. So it's about balancing the friction with keeping the business safe. What's also interesting in the small business space is the information asymmetry, right? Consumer has been an interesting space. There's the Consumer Bureau, and even though there is a lot of first-party fraud, third-party fraud, and a lot of verification challenges, at least there is a data symmetry. Small business historically has had a lot of information asymmetry in terms of KYB, KYC. So put the challenges on the data and having a full view against delivering a seamless experience with automation and high approval percentages while managing for losses. I think it's a fine trade-off, and that's probably the biggest challenge in the business right now for us.
Okay. So, Pamela, I want to turn to you. Obviously, you work with a variety of different fintechs and traditional financial services firms. What are some of the key differences between, when it comes to onboarding, what are some of the key differences between B2B and B2C onboarding?
I think they are significantly different. And one of the main mistakes that we see are people underestimating the difference between the consumer and the small business challenges at the onboarding point. For a consumer, the top of mind is the drop-off. The drop-off and the funnel conversion, it's critical when you think about onboarding. And therefore, the main goal is how do you reduce that drop-off at every single point? The secondary, I wouldn't say the problem that you're trying to solve is drop-off, but the challenge is, as Bill said, is the different environments and the omni-channel experience that you're trying to deliver. Customers are now discovering something online, maybe getting a quote online, then going to a store and trying to get that same quote that they got online in store and then walking away. And as Bill said, no one is going to stand in the middle of, I don't know, Home Depot and take a selfie or start scanning documents. That's just not going to work. So the ability to move seamlessly through different environments and completely almost make the application process completely invisible, it's the aim of that consumer. If you can completely take it away, that would be the end goal to drive that funnel conversion. In the small business segment, it's very different. Once a small business has decided that they are going to go and work with, for example, Lendio, they've already done the research. They probably already have decided they're going to work with them. But as I think Phil mentioned, they are frustrated. And it's that frustration that can lead to errors. It can lead to massive issues to time to revenue, because it could take like 10 days for them to fill an application in an environment that an application is not right. That can lead to false declines. And it also is a massive challenge for upsell and cross-sell, because once you've really upset that customer at that point of onboarding once, they're not going to want to do business with you again, because they've already had to experience that pain. So for them, it's a different problem. It's not funnel conversion, but it's time to revenue. And the major challenge for small business that we see is actually that third-party component. The fact that not all the time is it going to be the business owner, or is it going to be a sole proprietor actually fill in that application. The ability to enable a third party to complete the application and seamlessly pass it through multiple individuals to complete it, it's quite critical for that onboarding process. So it's not making it invisible, but making it dynamic.
Right. So let's dig into that small business process here for a second there. We just, maybe I can turn to you, Philip. We just heard Pamela talking about the frustration and the complication. I mean, small businesses, it's inherently more complicated because the entities, you're dealing with multiple entities. A consumer is a consumer, whereas a small business is run by a consumer, but there's a different entity. It's the small business itself. And then because you've got lots and lots of different types of documents, about processes during the onboarding journey. Maybe Philip, what are your thoughts there?
Yeah, I think you're exactly right, and you hit on a point that I think lenders in this space have been wrestling with ever since they created these products many years ago, which is, am I evaluating a person or persons, or am I evaluating a business? And until you get to larger businesses, typically in 5-10 million plus in revenue, these smaller businesses, you have to do both. There's just no choice otherwise. And so that's sort of on the decisioning point. But let me go to experience, and I'll come back to decisioning real quick. So experience, the applicant is acting like a consumer in that they are doing this in their after hours. A lot of these smaller businesses are people who are not behind a desk, but who are behind the wheel of a piece of equipment or a truck or working at a construction site and so on. They are not spending their time in front of a desk or in an office like you or I. And so they are not patient, don't have a lot of time, and often are doing a mobile application for business funding. And so the entire experience has to revolve around their need to get nearly instant feedback on their eligibility and find out where this is headed. On the decisioning side, I think is really interesting because the whole application process and decisioning process that we see at Lendio and what we work with on our lenders, and I'm sure Bluevine would echo this, Myra, is you're looking at the business as financial success or challenges from the standpoint of transactions. You're looking at credit, both the individual and sometimes the business with SBSS. And then when you get into things like owner criminal history, that's about the guarantor. Tax lien history would be about both the guarantor and the business. OFAC would be about both the guarantor and the business and so on. And so you're always kind of straddling those two issues. But you have to get to that level of depth, both of the owner and of the business, and in a way that caters to the types of businesses that are applying. These are people who aren't often in front of a computer to sit down and go through that elongated experience.
Mm-hmm. Mm-hmm. Mira?
Yeah, completely agree with that. I think the small business segment is inherently more complex than consumer I think there are 2 or 3 reasons, right? One, obviously, it's not just about the consumer. It is, you're answering, instead of 1 question, you're answering 3 questions. Is it a legit consumer who's applying? Is it a legit person? Is it a legit business? And is this person tied to the business, right? Like the 3 are critical questions, and inherently it makes it a more complex process to onboard. Also, the fact that not small businesses, we speak of it as one continuum, but these are actually fairly different. Right? Like mom and pop stores versus $5 million revenue versus $10 million businesses, they just act and behave very differently, which translates into the onboarding experience expectation and the due diligence in terms of transactions as well, right? The expectation and diligence is just very different across the board. And leads to kind of the other piece, which is from an organization perspective, when you deal with small businesses, you're also dealing with chunky exposures. Because unlike consumer, which is many, many small consumers making up the exposure, it could be 2 or 3 large exposures, which is what you're trying to manage. So it makes it inherently even more complex to make sure you're onboarding these businesses in a seamless way. To Philip's point, they are still expecting to be able to set up an account and transact right away, right? Like we have small businesses and we have a bunch of construction companies and we have gardeners. We have many of them who would go through the onboarding experience and they would want to cash in a check that they received from the customer the very next day. So it's just a very different way they work, and it's not going to be 1 check; it's going to be 20 checks because that's how they work. So there are inherent complexities to it, and it is honestly an understanding of the customer segment. I think that's probably what I can say on doing well by that segment. Customer needs, like a very large business, is happy to invest more in an initial onboarding journey, but a seamless process of no disruption in transactions. A smaller business, we've seen them want to be a little bit higher on quick onboarding, get the process to work quickly. Validations can also happen a little bit later. So there could be more emphasis on transaction controls than the larger businesses where the validations have to be more upfront.
Mm-hmm, mm-hmm. Okay, so Bill, I want to turn to you and talk about the consumer onboarding process. And as you explained, you're doing this in person at a physical location, but obviously it's still, they're not doing it, they're not filling out a paper form, right? So how are you managing sort of the friction in the in-person onboarding process?
Yeah, exactly. I'll go back. I'll start with, I really like how Pamela characterized it, which was that it's all about the friction, and the dream would be if you didn't even have to apply at all, right? So it's all about getting as close to that as you can. And in order to do that, it really is all about leveraging technology, especially, embracing and trying new things. So I think that for us, there's really kind of three principles. Like one is to give options, create multiple ways to approach the onboarding experience. So one thing that, we do, for example, is for some customers can start their application. We actually work with Prove, like using a product that lets the customer identify themselves using only their mobile phone number. We also like to try and focus on using what's in the wallet. So one of the most common ways that someone can onboard at the point of sale for a Sunbit BNPL is with their driver's license or government ID and a debit card. Not any manual data entry, but just using two things that you likely have in your wallet if you were going to the store or to the dentist anyway. And then I think the last sort of key piece is it definitely needs to be omni-channel. Again, Pamela brought this up, and I completely agree that the journey can start at home, could start on your phone. You could fulfill in the store in person using your own device, using hardware that we provide to some of our retail partners, and to the user, that just has to work. It has to be one seamless experience that's integrated, and leveraging these technologies is definitely the way to do it. And I think that in order to be successful doing that, oftentimes it's not just about the technical capability, it's about kind of having an innovative mindset about trying things and not jumping to conclusions about what customers will or won't do. I'll tell a very short story. When I started in this industry, one of the first things that I started working on was right when screen scraping bank aggregators were starting to take off, right? And we were doing, fulfillment for installment loans on the internet, and we're exploring linking a bank account using screen scraping as through an aggregator as a way to both make the process easier and to reduce risk. And I can't tell you how much skepticism I encountered from all of our management team around how ridiculous of an idea that was, and it would never work. And I would never put my password on a form online for my bank. And the alternative at the time was the penny drop. Do you guys remember penny drops? Like when
Oh yeah,
you did the micro deposit? Yeah, that was what we were trying to improve upon, because it meant customers had to wait 10 days to get their money. And so fortunately, what we did was we just tried it and made it really clear to the customer why we were asking them to do this thing. If you link your bank account this way, we can authenticate it right away, and then you get paid sooner. And guess what? 70% of the people who were presented with the option chose to do it in our first deployment. Because at the end of the day, customers are savvy, people are rational, and if you're willing to kind of be a little forward thinking on this and embrace the technology, I think that is the way that you stay ahead of the friction while not giving up the things that you're trying to achieve by putting these steps in the process to begin with. I mean, look at the bank aggregator as a great example. It's like, that's a win-win. Easier for the customer, more data for the platform. So that's how I think we like to think about it.
Yeah, and people love to do things quickly that are often painful. If it's painful, let's do it quickly. So let's talk about that. I know, Pamela, I want to turn to you and talk about this reducing friction, making it quicker. And Bill touched on it, but I know that Prove has this pre-fill technology that I thought was really cool. Tell us about that and how it works.
Actually, I am a customer turned employee to Prove, because a few years ago I was in the same place as Bill was. I had a product that had a terrible onboarding experience, had like 8 pages, and I had a chief risk officer that was like, I need this information, and I need it to be validated, so tough. And I started looking at the market and trying to find sources that would automate just the pre-fill. And there are a lot of sources in the market that will do it, but they don't guarantee that the information that they pre-fill, it's timestamp, that is actually valid on that day. It could have been valid at some point in the past, but not in that day. And I think that was what really attracted me to Proof, and how I ended up as an employee, is that the pre-fill technology, not only, yes, it streamlines and it can make it disappear, or it can just pre-fill the form. It depends on what the use case is, but it will streamline the experience of onboarding by automating and pre-filling the information. But it is with a validated information of the identity of the business or the consumer. And they do that, as Bill said, with as little as just your phone number. Again, depending on the amount of information that you need, if it is a consumer or if it is a business. And it can be as quick as, your 4 digits of your social security, and then it's done. And it literally can take 8 pages of an onboarding to 4 clicks with validated information. And it's a minimum of 70% pass rate, which actually means that it's not only the coverage, but the accuracy of it. I think Bill touched on this. It has to work. And actually that 30% says a lot more than the 70, because that 30% is probably things that you really, if you didn't catch it, you did not want to. So it's a really, really impressive piece of information that is enabled through the identity that is linked through the phone. And I'm probably not making it justice. Tomorrow, there is a deep dive that Proof is hosting with the product lead for our pre-fill on a webinar. For anyone that is more technical and wants to dig in under the hood, the webinar is tomorrow at 1:30 p.m.
Right. Yeah, it's cool technology. You look at it, you can see it on the website, and you just see, particularly on a mobile phone, which we're not as fast at typing on a mobile phone. If you just can type in your phone number and then have everything fill out, that's a huge win for the person trying to be onboarded. Anyway, I want to go back to the small business experience, and Mira, I want to go back to you, and because you touched on this, and because Bluevine has a lending product and a banking product, and I imagine the onboarding paths are different. Can you talk about that?
Yeah. So the onboarding process, instead of just saying it's different by product, I would say it's different by what the customer wants, right? I think that's the right way of thinking about it. And some of it is about the data sources that you have access to, right? In terms of a lending product, for example, someone comes in and they have an existing profile, they have a bank account, they're transacting on the bank account, and when we are underwriting them on the lending side, it is helpful for us to go get the bank connection, which enables us to underwrite them as a small business, which enables us to validate their existence, have some credibility and history without necessarily having to get statements from them, right? So certainly the onboarding process speaks to where the customer is, whereas on our banking side, it might be a small business and they are looking at a bank for the first time. So it may not necessarily be the validation controls, may not necessarily be as based on an existing banking relationship. It is based more on who you are, what the business is. And in addition, filling the gaps to what we just spoke about with Pamela, right? I think like in the current landscape of small businesses, also consumer, but small businesses quite a lot more because of the information asymmetry, it is about layering in different ways of getting to the right identity of the person and the business. So we bring in like a phone number validation, enables the pre-fills great. Also from the risk side, the 30% that Pamela mentioned, it's a great risk signal because somehow the validation is not accurate on that piece. Or you get applications from IP addresses, and they could be repeat applications from different IP addresses. So though it is a very different component to validation, it is a very strong signal for us to be able to weed out applications right at onboard that we think are suspect, right? And between banking and lending, there is also a size difference. Our lending products are geared towards slightly larger businesses, while we are very open on our banking product on small businesses across the spectrum. We don't do sole prop, but we are more open to businesses across the spectrum. And that also leads to differences in how we can validate data sources that we can use to look at small businesses and their existence. And also the first experience, right? Like how confident could we be in unlocking potential of transactions without a disruption at get-go? So I would say, yes, there are inherent differences, but it goes back to not just a product difference. It goes back to a little bit more on the customer's need and the customer segment itself.
Right, got it. Okay, so Philip, I want to turn to you and talk about a problem that happens, I think, probably more in the small business space than the consumer space, and this is someone who has started the onboarding process and then has stopped for whatever reason. How are you trying to go back to these borrowers and getting them to complete the process?
Yeah, maybe just another step back on a data point that I thought was really interesting on consumer engagement and digital experiences. McKinsey had done some research on sort of like, and I'm sure you guys have seen these hockey sticks of digital adoption before and after the pandemic. And so they had found that the consumers, this is people in their personal lives, more likely to do 80% of their interactions digitally. That grew by 3x during the pandemic. We effectively had like an entire decade of digital adoption in consumer in 18 months. And I think the consumer lending world has done an incredible job of adapting to that new paradigm where experiences are predominantly digital. I would say small business has been a laggard in this respect. And partly that is because a lot of the small business lending still happens with traditional banks. And most of those typically think of small business as a commercial activity as opposed to a consumer activity. We just talked a moment ago about how so many of these applicants are acting more like consumers than they are business leaders. But the other interesting thing about it is that 80% number is 80% and not 95 or 100. And so what it also means is people still often like to have some type of human interaction, not always and not all people, but that contingency has to exist. And so Lindia, what we're doing is we're constantly monitoring activity in our loan application experience, and we're looking for friction points, we're adjusting steps and rearranging them. But as it pertains to a given borrower, what we do is we do automated outreach. So SMS and emails out of the gate, followed up by a phone call when a borrower is stuck. A lot of times you would think maybe it's they've stalled out because they're no longer interested, but a lot of times it's simply because they didn't have the data available, and because they want to act quickly. Finding the bank statement or the login through Finicity or Plaid is a challenge because they don't have their credentials at hand, or whatever the case may be. And that brings me to the point you were asking about, which is what's sort of a common step in friction. We certainly find that accessing bank transaction data is a common step, and yet it's one that's like really paramount to how we qualify borrowers and how we match them with the right lenders. So we're monitoring that step, we're adjusting the aesthetics of it. We have a fallback option, not just for logging into an aggregator, but also for uploading bank statements and OCRing those, although that's not our preference, but that's something we certainly offer, as a lot of lenders do. And so the idea is to get them to re-engage, and most of the time they do. When they don't, typically it's just the time is not right, and they're interested in pursuing another source of funding. Is a less typical case, but it does happen. And we drop those into a nurture campaign and try to get them on the next go round is typically what we do.
Okay, so if you have a question for our esteemed panelists here, hit the Q&A button. We already have a few that have come in here. We'll get to those in a few minutes. But before we do, Pamela, I mean, Philip just talked about this massive change we had at the pandemic. And let's talk about that from a digital onboarding perspective. How far have we come in the last, say, 3 or 4 years when it comes to digital onboarding? What's changed?
I think it's very different from a digital onboarding to digital environments that are not regulated versus digital environments that are regulated, have a level of compliance. If we start with the first one, I have a really interesting nugget of information that at the start of the pandemic, the business that got loan applications related to COVID relief applications and so on, 80% of the ones that were approved were done by either a financial admin person or a third-party accountant or a bookkeeper, because the applications were so complex that the business owner did not feel qualified to do it, or actually couldn't do it and got rejected for the loan. So that's literally 2020, that was the negative information. That's how bad and how hard it was. So I think from that point in time, we've come a long way to try to move away from there. However, I think it's still, and that is at the front end in terms of the experience. I believe that in general, we see, at least at Proof, and a lot of my sales colleagues will agree that product leaders, unit leaders, business leaders is top of mind. The experience of the customer, that interface has to be slick, has to be good. That is top of mind. However, what is less understood is exactly what Mira was referring to in terms of the complexity of the data layer that you have to create to actually automate it and have a really good digital identity approval that is automated versus the cost. I think a lot of businesses think they can do this on their own, DIY. I say that because I try to do that, and it becomes really expensive. And then the cost and the return of investment doesn't play it out, and then they drop it. And that we see the failure, not at the front end. I think the front end, there is a lot of awareness of investment needs to happen, but actually in the risk office, particularly in the environments that are regulated, that's where we see a lot less investment and awareness that technology investment and the digitalization of the risk and compliance departments need investment, need help. That's where we see that. I think in the digital platforms that are less regulated, it's more about trust. And it's more about building trust. And how do you onboard someone that is easy to onboard, while still making sure that you are enabling trust and safety into your platform?
Mm-hmm.
Did that answer the question?
Yes, thank you. I want to, before we go to audience questions, I want to take a step back and talk about strategy. I'll open this up to anyone who wants to jump in. How have you created a streamlined strategy for KYC, KYB identity verification needs? Who wants to take that one first?
I can start with some views here. It's an interesting question, right? I'd say even before we get to the strategies, I want to just go through first principles of how we thought about the problem. And first principles, I think the first one was keep the business safe and make sure we validate ID in the least friction was a first principle for the business. Another first principle was, as much as possible, get the data in the back end to validate verifications, manage the connections at our end versus put the burden on the consumer. So one of the principles was don't put the burden on a consumer to validate it is who they say they are. Try and do it at our end. I think those are the two important ones for us. It is interesting because there is not a silver bullet in how you design a process. And I think this has been a question many fintechs struggle with, right? There is a cost associated with every data source. There is a cost associated with every process you want to invest in. However, the pool of revenue is small in the early days. How do you set that process of going through the controls? And our approach has been try and understand where we are most exposed to start building the process, and then layer in controls once you start with the largest gap, right? If third party is the largest gap to begin with on fraud, get the top 2 data sources you would want to get ahead of the third party problem. It's also been an automation manual trade-off, which has been incredibly critical to us as we have scaled up our banking business. In the early days, you would not be able to automate everything at get-go. And you would have to manually review a few, send in a few into operations to identify the right patterns. I think what is critically important is filling the feedback loop between manual and automated. As people review cases, identify patterns, feeding it back into your algorithms to get to a better state. The third piece has been tracking data and understanding what we see at a very clear level, right? From a strategy perspective, know where our exposures are. And the cost benefit of new data sources has pretty much been governed by where do we have our gaps. Once we got the basic gaps covered, we got to the path of where do we have our most exposures. We may not have lost money because we're manually solving for it, but let's get to the second layer of exposures and try and solve for those. So that's been our path to building out the onboarding process and setting up KYC, KYB and fraud.
Okay. Anyone else want to jump in on that, or should we go to audience questions?
I think one of the quick add-ons that I have to that is one of the things that we've heard the most when we've had customer discussions about KYB and KYC is this ability to also layer the checks based on the cost. So can I confirm this is an actual individual, you're a real individual, or you're a real business? Yes, I will do 100% checks and I'll automate that check to 100% of the applicants. That might reduce it to 80% of people and so on. So you start layering the more expensive checks and automations based on data or operational burden to the applications that become more real, more valuable. And therefore, instead of having to do 100% of the checks up front, you start layering them through the validity of that identity. That's definitely something that we've seen happening more and more, particularly in financial services.
Interesting. Okay, so let's go to audience questions. We've got quite a few that have come in here. Maybe we can start with someone says, I would like to understand how you are dealing with credit underwriting and the metrics used. Who wants to take that one?
I can take that one. Deal with credit underwriting all the time, unless someone else wants to jump in.
Go for it.
Go for it.
Okay. All right. Yeah. So credit underwriting, I'm assuming it's not ID verification. We're looking at end results, whatever is the performance. I'd say two things to think through as you measure credit underwriting performance. First, and I'm assuming automated. If it's manual, it's a slightly different metric. Similar but different. I'd say different matrices from beginning to end. In the application journey, certainly want to see the automation rates. How many decisions are manually made? How many are automated? And within those, there are loss rate trackings that you would want to have. You want to see early delinquencies, 14 days, 30 days, whatever is the metric at a product level. Depends on the product. You would want to track the early delinquency rate. One call out is it's important, and this is somewhat related to ID verification. Sometimes it's hard to distinguish for fraud from credit because there are IDs, there are documents that are fake, and it looks like you lost the money on someone who looked good on paper and you really can't figure it out. But in many cases, these are either forged documents or people, or it's even first-party fraud. I think it's very important to distinguish on first payment defaults. Critical to track it because that will help you figure out whether you got to go tighter on your credit controls or is it a completely different problem of fraud and ID validation that you really got to solve for. I'll also track like if it's a manual process, would look at the false positive, false negative rates on approvals, where we go with it. So I think with credit underwriting, these are more traditional metrics of loss rates, write-off, recovery rates, net write-offs, early delinquency, while calling out the first payment defaults and fraud rates as well. So those would be my take on matrices to look at for credit underwriting.
Okay. So let's move on here. Interesting one. How does the mainstream availability of AI tools impact your ability to trust that the consumer is who they claim to be?
I would definitely jump in and take like a little bit of a perspective on this, because I think this is actually something that we've been thinking about and talking about a lot at Sunbit right now. Is I mentioned earlier one of our preferred ways to onboard a new customer at checkout is with a driver's license or a government ID, and now those are getting easier to forge and things like that. So how do we think about it? I actually think that the adoption of AI is kind of no different in the biggest sense to any other vector of fraud risk in this type of, like, it's like synthetic identity or anything else. It's these risks are always evolving, and so you need to kind of approach it from two sides. On the detection and prevention side, you can't just rely on one thing. That's the biggest point, I would say, is that if you can leverage multiple points, then you're going to, it's much harder to defraud multiple systems than it is to create one synthetic document, for example. And so by comparing across multiple sources of truth, you can really manage the risk. But then the second piece I would say is you're not going to be able to prevent every single risk. So you have to also invest in containment, which is why I think, in every place that I've ever worked in the fraud space, one of the most important things we put in place is velocity modeling, which is that you need to be able to rapidly detect when you see an emergent risk in your business. I think that, Mira brought this point up, which I think is spot on, which is in the consumer side, you're taking lots of little risks, right? It's like, it's not one big exposure, it's lots of little exposures. And so the benefit that gives from the sort of containment of fraud is you should be able to see when you're beginning to see lots of little exposures accumulating and stop it before it becomes a large number, and your total, the amount that you're talking about becomes too much, right? And so I think between those two things, leveraging multiple different sources of truth in order to kind of not be overly reliant on any one individual piece of information. And then number two, suspicious activity will always manifest itself in certain telltale ways. Detect it and sort of shut down your risky channels when you see it. Has to be, you have to approach it from both ends, right? So
Interesting. Okay, next one here. Where does much of the friction come from in business loan applications, and how is this actually reduced? Is it through alternative data your firms can easily access digitally, or is it more through helping the small firm to digitalize its own data and share it?
I'm happy to take a stab at that one. The friction's everywhere. And it's hard to avoid it. I would say, as a general rule, it's make the application digitally friendly. And you're probably thinking like, well, what the heck does that mean? Shouldn't it be? And why wouldn't it be? I would say go kick the tires on some community bank loan applications and then flip over and look at what it takes to complete a credit card application with one of the leading issuers, and you would find massive differences. So that's one, is like creating something that's actually like a truly native digital experience that can be used in any number of devices and is intuitive. The second thing is to make it progressive in nature, so that you make the questions easy, and then any harder questions are pushed later in the process. And then as a related point, provide interim feedback on potential success. You're likely to be qualified. Here's a rough estimate of what the offer is going to be. Here's the last two things I need from you, and create a sense of success and fulfillment even as the application is moving along. And then the last one I think really relates to what Prove is doing is don't ask for data you can get somewhere else. If you can find the data through some other source, don't ask the borrower for it. So we talked about pre-fill and using phone numbers to access information. Another example might be, why would you ask about prior bankruptcies if you're going to go verify the data anyway? You're going to go get it. Like, you're not going to trust the applicant to reveal that information or be truthful. And even if they were, you'd go verify it anyway. Don't bother asking. So there's things like that you can do to adjust that experience. And so, I mean, to me, like those are kind of like the most obvious things. The friction is unavoidable, but again, more digital, more progressive in nature, interim feedback on success, and don't ask for information you can get somewhere else.
All right, that's really good points there, Philip. Okay, here's a question specifically for Mira. How do you mitigate the risks of registered agents opening accounts on behalf of their business customers?
This is a complex one. And this is a complex one because of, again, the information asymmetry in small business. It's not always easy to figure out. And again, I think this question, I'm assuming this question is not talking about a legitimate registered agent opening an account on behalf of the business. It is about a registered agent taking the data and trying to apply for an account, right? I'm assuming that's the spin on validation, because if it's otherwise a registered agent, then they would have access to all the information and they would be the registered agents. I think this is where, for one, there are some data sources out there where you can identify the connections between the business and the consumer. The data sources are not fully complete, right? You would not be 100% accurate in knowing, and depends on the size of the business, right? Like if it's a very large company, the number of authorized representatives for that business are much larger, so you're not able to identify a registered agent. This is one of those pieces where sometimes corroborating IDs through other means is helpful. For example, IP. Like usually if it is, I'm assuming a fraudulent intent here. So if a registered agent is actually applying, you are going to see some patterns on repeats. You're going to see the registered agent not just go after one company, but 2 or 3 that they work with. You're going to see the repeat application. So you're going to see some elements of shared names, shared addresses, shared details on the registered agent across multiple applications that are going to come at you. You're also going to see some linkages across IPs because they're going to try and transact across different IPs. They're going to be disconnects between where they see the business is versus where they physically log in from. So I think this is one of those pieces where it's not going to be an easy solve on catching that fraud if it is a registered agent and they actually have every element of data that they need to have to complete the application. This is where the triangulation on a few other pieces of information will provide a more robust answer and ability to make sure it's a legitimate application versus a fraudulent.
Okay, next question here. How do you measure the impact of fraud risk and identity verification tools on your business's bottom line?
All right, I can maybe take that question. My team does that all the time. We look at multiple data sources and we're trying to determine which data sources to use and how much does it contribute, because end of the day, our choices, and I kind of mentioned this in a previous, in one of the previous pieces on, you got a bunch of data sources, you have to make sure you pick those in the right order and have an impact to the bottom line. So when we're going through a data source evaluation, you're looking at it from probably 3 different dimensions. We're looking at the total coverage, right? Like bottom line aside, we're looking at, is it going to solve 80% of my problem? Is it going to be available for 80% of my population? Or is it incredibly niche and I'm going to know only 5% of the overall, right? I think that's an important metric because it enables not just conversations on what the bottom line is right now, because most fintechs volumes are growing. It's about exposure going forward. Second piece of evaluation is cost benefit. So we would start with the process the way it is, look at the total exposures or losses we have sustained from a process gap, look at the data source and see how much of the process gap can it fill. We will also look at false positives and false negatives, right? Every data source has a gap. There are some which are foolproof, but there's also a cost of customer experience. You're going to probably decline a few customers who you should not have declined. So we look at the false positives, false negatives. The total bottom line impact in our minds would be what we saved in terms of losses, and what we lost in terms of any false setups that the data brought in for us, right? And it is incremental. It is a waterfall. We start with the largest data source, and every other data source from that point is incremental. It's not about the absolute anymore.
And if I might add to that, from a proof perspective, every time we onboard, at least from the consumer side, every time we onboard to a new customer, we talk about actually giving full transparency of an ROI model, because that actually it's the greatest advocacy for us. Even our reporting in the reporting tool will show pass rates, so the customer is able to actually see clearly what is the pass rate, so what is the conversion that you get, what is the fraud prevention, what is the operational cost in that ROI model that is set up front, and then manage that through the lifetime of the partnership, I guess, between the customer and proof. We feel that is having full transparency of that ROI is what makes a difference between just being a data provider versus an onboarding partner.
Okay, so I want to close with looking towards the future and ask, what more can be done here? And with as you answer that, keeping in mind how you think digital onboarding is going to evolve over the next 12 to 24 months. I just want to love to get everyone's perspective here. Not a long-winded answer, because we only have a few minutes left here, but who wants to go first?
I can go first because I had a really short answer, which is a small fraction of the data about every consumer is able to be permissioned by that consumer to be shared. And that just needs to continue. So like open banking is a great example of moving in the right direction. Keep going, right? I'm thinking of the information that, the technology companies maintain around consumers, that the banking cores have around consumers. Like, we're starting to see this start to open up, and we should put that in the power of the consumer to share what's already out there. Because I think, like Philip said, don't ask for something if you're just going to go check anyway. So great. So just let me go check anyway, and then I won't have to ask. And I think that really is, I'd love to see that keep happening.
Okay, Philip, do you want to add to that?
Yeah, sure. Two quick things. One is embedded finance. I think it's been talked about extensively in the industry press for a number of years. And I think we've had some really incredible breakthroughs, particularly on the consumer side. I think it's been slower, and this is just kind of natural. It's been slower on the small business side. I think that'll continue to accelerate and get more up the hockey stick over the next 2 years. It's been growing at 25%, led by consumer. I think SMB growth takes up a bigger chunk of that going forward. The second thing is regulation on two fronts. One is increasing scrutiny around bank or regulated entities and their partnerships with fintechs. And so they're going to be more reliant on fintechs or put greater guardrails around the fintech side of the equation. And then the last piece of that is CFPB 1071, which is a new reg that's going to hit the small business lending world. And I think this is a space that's due for a pretty big regulatory shakeup. And if that regulation holds, it's going to be a big change for the industry.
Right. Mira?
Yeah, I agree with what Philip pointed out. I think the regulatory shift and the model where there is more onus on fintechs as well as the banking partners to closely watch who's being onboarded, how are we running our business, and KYC not being thought of as the minimum bar to jump, but doing what's right to build a robust framework. I see that as one of the biggest changes that is going to influence how onboarding is processed and how, in general, fraud's controlled, identity verification happens. I think the bar is going to be significantly higher on that front. That's my biggest trend for next year.
Okay, and Pamela, last word.
I tend to agree with what Philip said earlier about further regulation. As more innovation goes into connecting businesses and consumers and making identity more free in the market, the regulator is going to drive hard in increasing an increase in regulation around KYB, being very specific about use cases on how do you create regulation for specific use cases instead of generic use cases. So I definitely see an increase of connectivity and a push from the consumer and the business to have more digitalization. And at the same time, you're going to see the regulator pushing back and putting more and more restrictions on that. So we're going to have to get more innovative.
Okay, we'll have to leave it there. We are out of time. Thank you so much, Pamela, Mira, Philip, and Bill. Really appreciate all of your insights. I learned a lot. I thought it was a fascinating discussion. I hope you did too. Thank you, of course, to the audience, and thank you to Prove for sponsoring this webinar and making it all possible.